All right. Well, welcome to class. My name is Aisha Price. I work with Loudoun County Public Schools. I'm also a business consultant, and I have my own business called AP and Associates LLC. So today we are in the Small Business Bootcamp session 2, and we are talking about a lot of different topics today. So thank you for joining. Today, we're going to go over some of the homework and we are going to talk about some new topics. Some of them we've probably introduced a little bit to you before, but I'm going to reintroduce some more depth and detail information about those topics. We're going to talk about distribution channels today, registering a business, insurance, websites, SWOT, which is strengths, weaknesses, opportunities, and threats. We went over that a little bit last session, but I want to make sure that that's clearly understood. And we're going to do an activity today with that. We're going to talk about inventoriable costs because a lot of you have businesses that you need to control your inventory and talk about that inventory management. We're going to go over some business resources, the websites that I think that will be helpful for you, for your business, for you to be able to utilize. And we're going to talk about SIPOC. SIPOC is supplier input, process, output, and customer. And we'll go over that more in detail. We're going to go over some different type of contracts. And then I will be sending you a survey. Normally I send it after each session, but since some of you were in multiple sessions, I'm timing when I want to send that. But I just want to get the feedback of how you enjoyed class, the format of class, what are some of the things you still want to learn, and then if I can incorporate some of those things in the next session, I will go ahead and do that. Okay, it's more of a continuation. Next session will be a continuation, and the next session you will have to be prepared to come to class and start talking about the work that you did outside of class, okay, and to complete your business plan. So let's talk a little bit about inventory management. So inventory management, it really includes managing the inventory of your business, right? And we realize that when you're talking about inventory management, all of the departments that are in your company are really included in the inventory management. And I'm talking about your sales, your research delivery, your admin, your managers, all the operation management tools and positions that we talked about would really work together with inventory management. Inventory management, there's different types of inventory management. Of course, if you have to manage any type of inventory, you do need a point of sale system. A point of sale system is something that you can purchase online. It's always different based on the inventory, but it really would track the inventory that you obtain. It would track the cost of your inventory. It would be able to detail what each price point is for the inventory. Of course, we talked about overhead and things last week, and we're looking at our management overhead. This is really going into adding that management of overhead to your inventory and making sure that you're pricing your products out correctly. I do want to go over and see and talk about the pricing structure that we talked about last week, our price and cost, because part of the homework was for you to create a price for your business or price for your service or your products, and for you to look at that markup and also look at management overhead and what is your management overhead rate. And so we're going to go over that before we end class today, just so I can get an understanding of how well you guys are with understanding that material. And then so I know what areas you need help with when it comes to your management overhead, because it's very important to make sure that you allocate your costs correctly, the cost that you have for your business, as well as making sure you understand the pricing for your business, okay, for each product and service. And we know that we learned last week that there's a difference. So there's some inventoriable management methods. Some of them you may have heard of before. When you have a point of sale or inventory management system, the inventory management system will track all of this for you. But these are just the old school ways of how these systems are designed and why they look at these different dates and transactions. So LIFO is last in, first out. That really means whatever you purchased the most recently would be sold first, right? And then first in, first out, that means whatever you sold the whatever you purchased initially, that inventory that was sitting on your shelves and that you want to get out. A lot of times people would do, different markups for that, or they may do discounts because they have products. You see, when you're going to a store or when you're online and you're purchasing things and you're wondering why, something is priced lower, it's because they may have a surplus of inventory, right? And surplus means you have a lot of a product, okay? And so so when you have a lot of a product, you want to make sure that you there's a point in sale where you're looking at where you have so many products, but you want to get that inventory out. You still want to recoup some of the cost for it. You don't want to discount it so much, whereas you wouldn't make a profit for it. But there is that's just one of the ways that we manage inventory, how we it's based on the date of purchase. Okay. Perpetual inventory is there's still a system. If you want to do your perpetual, they would do inventory updated with each sale. So your system would update the inventory upon each sale that you make, or we have a process where it's periodic, where you would update your inventory each period. And when I'm talking about inventory, it's you're checking the inventory that you have already in stock, your work in progress items, the ones that are already completed, that have already been produced and manufactured and created, and you want to sell them. And so you either decide, if you set that up when you do your point of sale system, and you would tell it initially, do you want to allocate the inventory, update the inventory each time you sell it, or do you want to update the inventory each period? Regardless if you do an perpetual or periodic, you're still going to have to do inventory management in regards to count. You would have to do a manual inventory count, because you want to make sure that whatever you have in your system is correct with what you have on your shelves. And when I say inventory, any of those products that you're using to create a final product. Okay. Because sometimes you may have a certain product and it may take other tools and other materials to create that product. All right. So we're looking at, the inventory as a whole, what you created and what you have on shelves. Inventory is an asset. So of course we know on the business side, on your balance sheets, that the inventory would show how much inventory you have, and that doesn't count against you. It counts for you, because anytime you have inventory as an asset, assets count for the overall asset of your business, the profitability of your business, the capital, anything that could be liquidated. Liquid is something that could be easily turned into cash. And so inventory is always easily turned into cash once it's completed, right? And then really your point of sale inventory management is looking at the value of your inventory. Okay. Cost of goods sold. It also, inventory management system would track your costs of goods sold. And cost of goods sold means what are the costs of the goods that you produced, okay, and when you sold them. So we talked about last week that cost and price are different. Cost is what cost you to make that product. So we're looking at the cost of the product of the goods that you sold. Okay. And then there's another method called average costing method. And that really looks at, say, for example, you're ordering items and you have an average of what you need, and you're looking at, okay, to make this particular product, it's an average of this amount of materials, and this amount of materials, the average cost would be this amount for those materials. We're going to watch a video a little bit more in detail so you can get a little bit more understanding about it, but I wanted to just give you a simple overview of that. I also posted some of those videos on Schoolology. One of the videos is called Inventory Management. The other one is called LIFO, FIFO, and Average Cost, and it goes over the differences of those. And then the last video is 11 steps to inventory cost methods. We talked a little bit about pricing strategies before. We're going to watch a video that talks about pricing strategies. So there's three different strategies that you use when you're pricing your product. So the first strategy is cost plus pricing, and it's really a general markup. The percentage is applied to the price to cover operating the business and to generate a profit. And we looked at that last week when we talked about management overhead, and you saw the video where the store owner added up all of the materials and all of the labor, right? And then he divided it by his indirect costs. The indirect costs are those different costs that you incur each month for your business, right? Excuse me. So you have your rent, you have your utilities, you have any other expenses, you have your administrative costs, marketing, research, development, all of those different operating costs. Those are indirect costs, whether they're flexible costs or their fixed costs. It doesn't matter. It's still inventoriable, it's still an indirect cost. And those costs, you would look at those cost matters in order to determine your overhead rate. So when we look at the cost plus pricing, you're talking about that overhead rate that you when you came out to that final amount, when you divided your indirect versus your direct cost, and then you came up with a number, okay, or percentage, and that number would be applied to everything that you do in regards to the pricing of your products, okay. And then we always talk about, if you're going to sell a certain product, you want to look at what that markup is, that's applied to it. Value-based pricing depends on the value and benefit of the product to the consumer. We watched a video last week and it talked about the difference between how much it cost you to produce the product, the difference between how much it cost the consumer if they wanted to purchase it, and then you look at the benefit and the value. So items that have value, and then items that have are like quality items, you can charge a little bit more, and as well as items that are more so in demand. And we see that now, as though when COVID hit and the different changes in the economy, that we realized that the demand for the products increased, but we didn't have the supply for them because we weren't able to um, get them readily available because the cost to create them, right? Or there was a shipping issues, or we had, some different type of interruptions in that process. So what we do is we look at the value of the product and we look at the demand, and we realize we don't have a huge supply of that. So we're able to charge a little bit more based on the value of the product. And then we look at how much the customer values, because when you think about a product, it's really about, or service, it's about the value that you're providing to the consumer and the value that the consumer perceives it to be. And if you notice, when people buy, high-end products, right? A high-end product may have that big price tag to it, and it would be more value-based pricing because it has more quality material. Say if you're buying a shoe and it has leather in it, instead of having polyester or polyurethane. So there's different reasons why. Also, if you're in a market where a product is not readily available, an area where it's not readily available, or it may be costing you more as a producer, as a manufacturer, to create that product, and people still want it, there's high demand for it, that would be a value-based price that you can charge for the consumer. Dynamic pricing is based on the demand of the market. And so we'll see that when prices are in high demand, you'll see that there's a huge price tag associated with that, because unfortunately people need it, they want it, but they may not be able to afford it all the time. It may be something that they're buying, periodically. If you think about GameStop, when GameStop there, because we had stock in GameStop, and eventually we saw that the stock just went up astronomically, and we're wondering why. Well, during COVID, a lot of people couldn't go anywhere, and they couldn't go out and do activities, so video games purchases went up, and during COVID. Okay, so we see that that's happening. And then with some of the commodities, our food commodities, we saw that that was happening. Medicine, things of those nature would be considered dynamic pricing, because it's not something that you readily have available. You may have a lower supply of it, or you may have a good amount of supply, but the demand of the market is so high. We see that right now with housing, with real estate. Okay, so you can see how these different price structures will allocate to your different product and services. And sometimes people, are afraid to charge a certain price because they think the consumer is not going to want to buy it. But when you look at, if there's a demand for it, you can look at the value it provides, look at the quality, excuse me, that it provides to the consumer. And really the market determines what people are going to pay. Okay. So when we do our SWOT analysis today, we're going to talk about the differences and the different SWOT analysis for different businesses. There's one that we looked at last semester about Starbucks. Starbucks is a company that they do a lot of value-based pricing. And why? Why do they do that? Does anybody know? We know they do it because the value of the coffee that they're providing, the quality they're providing, the experience they're providing, the atmosphere they're providing, right? They're doing different specialty drinks. And although it may not cost them more to create and make that coffee, It may not cost them more to get that from the manufacturer, but the value that the consumer has placed on that product has made Starbucks so valuable to our economy. If you go into the grocery store and you're trying to purchase different products and different coffee brands, you will see that when you look at the price, Starbucks coffee per packaging is so much greater because of the value that consumers placed on it. Some of you may not think that it's that great of a coffee, but because of the value that they've placed on their product and the specification that they've made for each consumer. And if you look at their marketing statement and they talk about, making coffee enjoyable one cup at a time, their experience is what people are paying for. Okay. Distribution channels. So, a distribution channel is the network of businesses or intermediaries through which a good or service passes until it reaches the final buyer or the end consumer. So, we understand the distribution channels can include wholesalers, retailers, distributors, and even the internet. So, the internet is a distribution channel. Why? Right? We see that through Amazon and a lot of different stores now, Shopify and Etsy. We see that the internet has become one of the biggest distribution channels. Unfortunately, things like COVID, yes, have made that so. But that makes it so individuals have the products that they need when they want it. Okay. And the wholesalers are deciding that, okay, we understand that if you're creating a product or you're manufacturing a product, you're going to have to come to us to get the materials. Okay, so a wholesaler is someone you would go to that has a product in bulk and they're able to give you a huge amount of product and most likely for a more reasonable price. Retailers are selling those products. Okay, so they receive those products from different manufacturing companies. They pay those companies a fee to go ahead and send them over the materials. They're paying for that product to already be created, and they're actually selling that. So they're the intermediary between that. And so they're the intermediary between the wholesaler and the consumer. And they're controlling the transaction. So if the retailer sees that consumers want more of a product versus another, they're going to charge more of that product versus the other. So they're going to have different complements of products. They're going to decide based upon the background of and the sales history of certain products and certain brand names and certain materials. They're going to decide where they're going to put that product in their store. And if you ever notice, if you go into a grocery store and you see certain products on different levels of the shelf, so the higher items on the higher levels of the shelves that are more eye level, the retailers have priced those up because those are brands that individuals purchase more regularly than others. There are also brands that may have a little bit more of a price tag to them, but consumers have said that that's what they want and the demand, and so they provide a certain amount of supply for that. The items that are closer to the bottom of the rack are more the lower tier products. Doesn't mean they're anything less. They may be a different brand. They may be specifically tailored to someone else because they lower that price tag for the consumer, but they realize that the consumer needs to have options. And it's also a marketing trick, right? The retailers decide based upon the past sales and based upon what's coming out into the market, what's new, what's trending. And so they control all of that. Okay. So you can go from one grocery store to another. We talk about Walmart and Target and maybe Harris Teeter and Wegmans and Whole Foods. And you'll see in those different stores, think about looking around and seeing that when you go, if you go out into the grocery stores or if you go shopping, go look and actually take a look at what you see. Okay. I think sometimes we don't realize that all of this is marketing. Okay. And distributors are, they're distributing that product to you. Okay. So they may not make the product, they may not sell the product, but they are distributing it to you. Okay. So you notice that now we have Uber Eats and things of that nature. And when they're distributing a product, there's a certain surcharge that you're paying for someone to deliver. You're paying a surcharge to Uber Eats. You're paying a surcharge to DoorDash because they're distributing that product to you at a price. So you are going to pay a little bit more of a cost for that. It's because it's a need and a want and a demand in the consumer market. They realize that you can get that product easily. And so they decided, hey, well, if I can get that product easily, but also if I were to charge a little bit more to get it, it's convenient for me. So I do a lot of shopping um, through Uber, but I also do shopping through Instacart. I started doing Instacart when COVID came about because I am at risk of getting COVID and getting sick. I got COVID once throughout that whole time frame, although there were two different strains of COVID, and I got COVID like a year and a half later. And the only reason why I got it is because actually went. They believe I went to the grocery store and got it, but so I stopped going to grocery stores, and you really don't know exactly where you're getting it from, but the point I'm making is that is something that a distributor decides. Okay, if I'm going to be shopping for you and I'm going to, you tell them what the items are you want, okay, and then you pay them a surcharge for them to deliver those items to you, okay. And so you have to think about all of these when you're talking about your business, right? You have to decide if you're going to be a wholesaler, if you're going to be a retailer, are you going to be a distributor, okay. And the internet is a great place for you to try that market. We see now that Amazon and different companies have taken that over, and I know there's some mitigation out there with Amazon because they're basically saying that Amazon is trying to be a monopoly and monopolize the market for distribution as an intermediary before businesses, because they're charging a certain amount, but they have so many different choices, right? That you can go onto Amazon and find almost anything you want, and then you could join Amazon as an Amazon member, and you can get a membership. And then when you get the membership, you may get free shipping, or there's a certain amount. You can also get items delivered to you automatically if you fill out the common customer list. So I personally use Amazon and do a lot of online shopping and Instacart and things of that nature. So I'm an advocate of it. However, you have to be able to absorb those costs. So there are going to be costs associated to utilizing any of these distribution channels. And in your business, you have to determine which side am I going to pick. Am I going to be someone who's a wholesaler, a retailer, a distributor, and how am I going to do that? And what's the best method for me, and what's most cost effective for my business? And you need to allocate your pricing structure to fit that model. All right. Budgeting. We are going to watch a video about budgeting. Budgeting for your business is key. It's essential. If you do not have a budget for your business, I do have one on Schoolology that I know I talked to you last week about creating a preliminary budget, but I have one on Schoolology, which I'm going to show you guys in the slide. But creating your business goals. So your business budget really aligns with your business goals. So whatever those goals are you have, for your business, those are going to align with those. And we talked about those strategic goals and making the goals really plain, outlining what those goals are, putting deadlines, making those goals smart, right? Specific, right? Making those, yes, our business. Yeah. So yeah, I can understand that comment. I'm going to explain that comment that Chris said in a few minutes. But yes, making sure that your business strategic goals align with your budget is so important, because how are you going to know, how are you going to forecast your sales or your projected sales if you don't have a budget? How are you going to you have to be able to identify your business expenses, right? And how much it costs you to run your business each month. You have to know how much your direct labor and your direct materials cost for you to be able to say, how much do I need in order to sell, to make these goals for my business, these quarterly goals, these monthly goals, the annual goals. So identifying those costs that you incur each month, each quarter, and annually is the way you would align your business and the way you would set it up. And then you have to track the actual versus estimated cost. So for a budget, you're always going to have the estimated cost of what you believe a price should be, what I estimate an expense to be. So if I estimate that my rent for my business, that my utilities is a certain price, that the car is a certain price, and then it fluctuates each month, or my research or my marketing and development, it may fluctuate because I may actually be having a marketing campaign at that month, or I may be doing some research, or I may have sold more product because seasonally I may sell different products more or services more than another season, right? And it depends on your industry. Some industries do really well in the summer months. Some industries do really well in the winter, fall, and spring months. So you really have to know your business and realize when are those times of the year that you're going to produce and sell more of those products. Like for example, for myself, I in the summertime I can do workshops, but in the summertime it doesn't benefit me as much to do a lot of classes and seminars. Now I can do them on the weekends because people are sometimes available on the weekends. But historically here in this Northern Virginia area, a lot of us are government and a lot of us are in education and military. And so we live by whatever goes our schedule goes along with our kids. So if our kids are out of school in the summer, most likely we're still working. But what happens is that's mostly either we're working or we're taking vacation, and that's pretty much it. People don't want to have extra chores and duties because they need a break. Okay, so I have noticed that in this area during the summertime, that business is a little bit slower for me. So I choose to do other things with inside of the school and other clients, and I work with them doing workshops and different things. And that's my opportunity for me also to take a little bit of break and do a summer vacation, because I realize that my business really vamps up in the fall and the spring and even in the winter. So the summertime is pretty much a more of a down time, and that's for me to do some of the administrative things that I need to do for my business. But it's not like that for everyone, depending upon your industry. I know Anna's husband does HVAC. So in the summertime, his business is going to be booming because everyone's AC goes off. And in the winter, everyone's AC and heat goes, bills go up, and you have to deal with the furnaces and all those different surcharges and stuff for that. Yes. So it just depends on your industry. Okay. And really looking at the actual versus the estimated. So you can decide, hey, this is how much it's estimated costs. But when you go back and review your budget and review that budget bank account, which you have a separate account for each bit for your business, when you review those expenses, you will see that my actual versus my estimated is different. There's going to be a difference between the two. And that's when you have to make those changes and monitor that. Reviewing your financial statements, seeing where your cash disbursements is, your cash flow, your income statements, your income and revenue, as well as your expenses are that we talked about. Looking at those and really reviewing those different things, okay, to make sure, looking at your inventory and what you have available, because your inventory is an asset and that's going to be on your balance sheet. So looking at your financial statements and reviewing them is a helpful tool in making your budget as well. And I really suggest that everyone would take the time to, regardless of what business you're in, to purchase some sort of bookkeeping software. We met with Thomas last week, who is an accountant, and he does bookkeeping, has a great tax service business as well. And he has, he recommends his bookkeeping services, but, it's really industry specific. So I always recommend ones like QuickBooks and things of that nature because it links up to your bank account. But there's also other ones that people use depending upon their industry. So making sure that you have some sort of software that is tracking your income, tracking your expenses, looking at the bank statements, and really taking some introspective looks at those is going to help you with managing your budget. Okay. One thing I will talk about is SIPOC. So SIPOC is really talking about your supplier. You're the supplier, okay? Input is looking at all the different work and transactions that you have to do from the internal side of your business, right? To make and produce that product. And then you look at the process. What is the process that I have to input in order to make sure that, for one, I'm making my products, my services, and how are those services getting to the consumers? So you're looking at all of those different things. And the output is the actual product that you create or the service that you create. Okay. And the consumer is C is the customer, the consumer. So you really want to understand from the time you made the product, the time you created it, what's that process, and then what is the process to get that product or service out to the consumer and the customer. And then also looking at the feedback of the customer and the customer's experience of that process. And the SIPLC really looks at the differences. And if you have some challenges with that process, it helps to evaluate what those challenges are and to identify, say, for example, a product didn't get to the consumer on time, or it was something that they did not order, or they ordered it, but it wasn't done to the standard that they wanted, or something was missing, or you delivered a product, or you created an item and the customer wasn't happy with it. Or say there was something when you did the research and development of that product and you found through the research and development that the product isn't functioning the way you would like it to function. So what is this? So you have to go back and review your process and maybe put more steps into that process, right? And then making sure that the consumer is happy. So what if the consumer is not happy? So you'll watch a video where it talks a little bit about there's a great flow charting process where you can create the process, and there's different symbols that we align to parts of the process to determine how the process is going. If this part of the process is going well, we say yes. We use a triangle for yes, and we may use a square for no, right? And if the process isn't going well, if there's a no in that box, then what do you need to do different to change the process? Okay. So those are the things that we're going to watch some videos about and talk about. But I wanted to make sure that you guys have, a clear understanding of these type of concepts before we go into the video. And then once the video is done, we're going to take a break. And then when we take a break, we're going to go over a SWOT analysis. And I want you to be able to identify to me some of the characteristics of a SWOT analysis for your business. And then I'll go over what those mean, and then you'll get an opportunity to do an activity with that. Okay, so I'm going to stop the recording. Does anyone have any questions before I stop the recording? And if not, you can ask them after the recording. But I wanted to talk about Chris's comment, and he mentioned something about the issue we have with Amazon. Sometimes Amazon, maybe you making a product, and Amazon, you build a great price structure to help your business grow, but Amazon is selling the product at a much lower price. And those are the reasons why you have to decide what the distribution medium is, right? What's your distribution channel? How do you want to distribute it? And if you don't want to distribute it through Amazon because it's costing you more to even produce the product, and then Amazon is not giving you a fair share of the profits of the product, then you don't want to use Amazon. Okay, but I do suggest that still you can have those products. You can create that on your own line, on your own website. And a lot of websites now have an online store, and you can, like, for example, my website, I have a shopping cart on there, and people can go in and look at the items that they, the classes or the services that they want, and put it in their shopping cart. So you can always create a shopping cart for your own business and put that on your website. So that way, if you want to sell items through your site, you can go ahead and do that. You can add the sales tax and do all of that through there. Okay. Yes. Did you have a question, Chris?
Yeah, that's actually true. My other point, though, with that was the fact that 9 times out of 10, somebody will be standing in front of me and go, "Oh, well, that's right. I saw this on Amazon for only $2. I don't know why yours is $15. So that's always a debate. When as I'm actually manufacturing a physical product, that's always the big challenge these days. Between it's not just Amazon, it's that Walmart,
Right.
Target, wherever. So we always have to justify why. That why. So it's an interesting dynamic these days.
Yeah, and a lot of the why is, the quality that you're providing, because you can go and buy anything, for $2, but what are you getting for that? Are you going to be able to return it? What's the qualities that created with it? What type of fibers they're using? Right now, people are really about quality. They're about, organic or vegan materials. They want to know what your brand is. Are you a company that puts money into profit sharing, or you're a company that decides to give back to the community. So a lot of it is what you're saying after that message. But I do realize that sometimes people just want a buck for a buck, but the individuals who just want that's most likely not your type of consumer, right? So it's really identifying yourself as a quality product. And once you start putting the ingredients and the reasons why, then people start to see, okay, and then customer reviews and things of that nature. But I do understand that a lot of people want to utilize Amazon for that, and sometimes it does benefit you. And then if you think that maybe you can charge, you can charge any type of price point on Amazon, it's true, and you can justify it, and they just may choose another product regardless, okay? But they may look at yours and say, you know what, this product's priced a little bit more, but based on the description that I see down here, this may be a better product for myself. So it just depends on, who's looking at it and what they're looking at and what they want to purchase. But I totally agree with you, Chris. It's not, it's not a set in stone type of thing, but we know that this market is people are fickle in this market. And it's really all about demand. And so if you have something that's in high demand, unfortunately, they're going to pay, regardless. They may compare a few of them, but they're going to pay for the price that they want based upon what they see adds them the most value and benefit. I totally agree. All right, I'm going to stop the recording. Thank you for sitting with me for this part of the conversation. And then we're going to watch a few videos, and you can have any questions you would like to ask. You can put them in the message box, and I'll go ahead and address them. All right, thanks.